Okay, good afternoon or evening to everybody, and welcome to our Week 5 lecture for PSC 603, intended for distribution on February 14th, 2022. In this session, we're going to talk about an area that's very important, but from the standpoint of most people's work in public administration, is not something that you necessarily will do, but it's some information that you need to know about, especially when you're working in budgeting, and also when you're working in understanding how finances work in government. And that's when we're going to be discussing governmental accounting tonight. This is a short section in the text from pages 80 to 87. And there are in other textbooks, it's actually gone into significant detail, but for our purposes, for this session, and in the way that this text is presented, and the way this class is structured, we're just going to focus one lecture on it so that you have an understanding of what you need to know. And obviously, if you choose to go into budgeting, or you're financially minded and you choose to go into an area more specific to government finance, there's a lot of additional professional development education that you will have access to help you get better understanding. But this is a good cursory understanding, a good overview understanding. And I would say for most people, for probably 95% of the people that work in local government, this is the understanding, or at any level of government, this is the understanding that they need to have in order to be able to be proficient in handling government financial issues. So our overview for tonight, again, we're going to be focused on the section in Chapter 2 of Mike Sell, focused on governmental accounting, which again is on pages 80 to 87. I will spend a little bit of time at the end to go over the Week 6 assignment. Really looking forward to next week's class. And then also remind you about the lab exercise. I've already recorded and posted the video with respect to our continuing discussion of the budget worksheet and the assignment with respect to the budget worksheet, which all will receive by email. So let's go ahead and start it with governmental accounting. So if we want to understand accounting, accounting is really, is a process that pretty much any entity has, from a small business or even a household to largest organizations. And of course, as Mike Sell puts it in the first sentence of his section, proper accounting and reporting makes government finances more transparent to constituencies. It also improves accountability to the public, allowing the public to see whether current revenues are sufficient to cover current expenditures, and also make it possible to evaluate the operating results of the governments on a periodic basis, usually from the perspective of a fiscal year. There's a lot of information that's done, and it's not just purely financial, but most of it is. But as we've said before, when it comes to providing and facilitating the resources necessary for government to effectively function, it really comes down to finance. And hopefully that's something you've learned a lot as we've discussed so far, and will continue to pick up. So the first thing that we have to keep in mind is that, like any practice, that there are standards. Generally speaking, when we talk about standards in accounting, we refer to them as GAAP, or also known as generally accepted accounting principles. And again, for those people who work specifically in accounting, those are very important. Those are regimented guidelines that they follow in the appropriate tracking and following and booking of revenues, expenditures, and a whole host of other issues. It's a very complex field. Even people who come from the private sector accounting and go into public sector basically have to learn a lot, because there's a significant difference between how the private sector does their accounting and how the public sector does its accounting, particularly how governments do their accounting. And these standards, which are used to kind of adapt these practices, are established by what they call standards boards. And there's two standards boards related to governmental accounting in the United States. The first one is GASB, and that's the Governmental Accounting Standards Board. That's the one I'm most familiar with. And they deal with setting standards for state and local government budgets. And they are very active in that. FASB is the one, it's the Financial Accounting Standards Board, and they set the ones for the financial sector. There's also FASAB, which the Federal Accounting Standards Advisory Board, it sets them for the federal government. But GASB is probably the one you need to be familiar with most. GASB does primarily with state and local, and I know that's where most of y'all work and where most public sector professionals work. So that's really the one you need to be familiar with. And they amend their standards on a regular basis. It's a prolonged process, much like any other regulatory process, where they do research, they do analysis, they figure out where the best way to go. They go through a comment period to set these standards, and these standards are put in place. And these standards help adjust the generally accepted accounting principles, and also help establish and govern what jurisdictions do with respects to their accounting systems. Mike Sell talks about 4 key elements with respect to accounting systems that we need to understand. The first one is the source documentation. So I want to kind of frame this from the perspective of, let's say I have an expenditure that I need to get paid by my government's finance department. So the first thing is that I have to have source documentation. This is a very important element of the process, and this is basically the record of making sure, first of all, that I've gone through any necessary procedure or policy that the city may have with respect to procurement or purchasing, and that I've gone through that I have completed the order, that the vendor providing the good or service has acknowledged the order, that they are providing the service or providing the product, that the product has been received, and then that there is a proof indicating receipt of product or receipt of service, so that there can then be a necessary information provided to the government in order to pay for the expenditure. And that source documentation can take many forms: receipts, invoices, other original details of transactions. And all that backup has to be kept with respect to each transaction that occurs within a government. And there are standards that are set typically at the state level, but also at the federal level, for how those records have to be maintained and how long those records have to be maintained. Then, of course, it gets into the accounting system, and they use it through what are known as journals. These are a chronological summary list of all transactions, and these are maintained in accounting systems, also known as ERP systems. And whether it be handling an expenditure, receiving revenue, adjusting the budget, these are all journal entries that are tracked throughout the system. And this indicates that these transactions have occurred and go forward. Then you have ledgers. And ledgers are the reports that are at varying levels of detail that present the balance in any revenue, expenditure, or other account. And typically, we also refer to them in the ledgers. That's oftentimes what we think of when we think of budgets. So in a ledger, you typically have information about how much is in the budget, how much has either been received in revenue or expended, and then, of course, it provides you information about the amount that's available, or the amount that still needs to be collected to balance. And these ledgers are basically summaries of the impact of all the transactions and it's done at an account level. Then you have finally the procedures and controls. These are set in place within an institution, and particularly with local jurisdictions. They of course have to abide by state regulations regarding procedures and controls, as well as those set up by GAAP. And they are the instructions that help classify, record, and report financial transactions, and handle, of course, how you prepare the source documents, what source documents you need, how journals are prepared, and of course, how ledgers are kept. And this is all very important because it's all essential. In order to ensure transparency, you have to have complete records that are available, particularly as you go through the auditing process, which occurs at the end of every fiscal year, or can occur more frequently depending on how circumstances present themselves. Mike Sell points to some key things to understand about governmental accounting, and he talks about this on page 81. that when we talk about government accounting, we're really focusing on cash flows and improved transparency. In the private sector, you're looking at profit and loss, and that's understandable. But in government, obviously, you're working with balanced budgets or laws I've talked about. You're really trying to manage funds. Budgeting is financial planning in a large sense. You have an idea of how much revenue you're going to receive, and you need to properly allocate those resources. And accounting works in the ongoing daily, short-term as well as long-term management of that. And there are some particular practices in governmental accounting that are a little different or significantly different compared to what we see in the private sector. And the first is this concept of fund accounting. This is where we typically segment pools of money based on certain characteristics and keep them separate. We don't commingle funds. So, for example, if a jurisdiction, and we'll talk about this a little further when we talk about the types of funds, if a jurisdiction is involved in providing general government services like police and fire and public works and parks, but also has utility services like electric, gas, water, and sewer, our standards require that those utilities be in separate funds and accounted for separately from general government operations. And they're managed separately when it comes to it. The next thing is that, of course, debt is segregated. This is a big difference, and it gets into capital and how we handle capital. I think the explanation here on page 81 is pretty sufficient for now. We'll talk a little bit more about debt later, but debt is segregated. Bonds or other kinds of financial instruments that are used to finance, to acquire debt, are repaid from general financial resources of the government, and they are reported as obligations of the entire government. However, bonds to be repaid from specific funds are reported as such. So when you finance, again, you're financing or using debt within each fund. So like we finance a lot of expensive equipment in our electric fund. We have transformers that could cost over $1 million. And we finance those, and we pay those typically off in about 10 years. We use what's called installment financing. And we use electric fund revenues or electric fund monies to pay for that debt. Whereas with respect to general government, we're using general obligation type instruments to pay for that kind of debt that we have to use for paying for general government expenditures like purchasing fire trucks or building new facilities. Third, the government budgeting is paramount. As he says here, the budget of a government is the heart of its system of checks and balances. Demonstrating compliance is critical to accounting and reporting systems. In the private sector, budgets are more on the order of an initial flexible plan, and nonprofits are somewhere in between. But as I like to say in government, budgeting is law, and you have to abide by it, and everything is structured in a large sense to be able to facilitate that. So these are important practices to understand. Let's now talk about the different kinds of funds. And for that, we're going to go to page 82. And as he talks about, in the private sector, everything's kind of tied together within an institution. There may be some separation with respect to business units, but when we look at it in private sector, it's all kind of tied together. However, in government, we separate funds and accounts because there are legal restrictions on the use of government revenues and on the purposes of government expenditures. So we have to be very careful with this. And so for budgeting purposes, for reporting purposes, and for active management purposes, we separate it into funds. And there's 3 different types of funds that are gone over in this. And it doesn't mean that there's only 3 funds in an account, but these are the different types. And I will show you in the example, I'm going to show you a financial report, the most recent report for Rocky Mount, and it kind of shows you how everything's organized. So the first one we have are governmental funds, and these are those that are generally associated with traditional general government operations. This would include the general fund, which is really the most common fund you find in all government, state and local. This is the general revenues to the government that are collected by that. It would include taxes and fees, those revenues that are collected generally. Most of your expenditures tied to the services that the general government is projected to provide is there. And typically, in reality, there's only one general fund per governmental jurisdiction. The next one is the special revenue fund, and there may be multiple of these in a jurisdiction, but these are taking care of specific operations of general government that are supported by dedicated revenue sources. So an example of that we're required to have in North Carolina as a municipality that operates an E911 dispatch center is that we have to have a separate special revenue fund for the administration of those revenues that we receive from the state from the E911 tax. It's the taxes you pay on your phone bill. And that has to be managed and accounted for in a separate fund. There's very tight restrictions on how the money can be used. And so that revenue is booked, that revenue is collected in that fund. It's an annual appropriation we receive from the state based on a formula. And then those particular eligible expenditures are expensed in that fund. And that's part of our annual operating budget, but it's kept in a separate fund. A lot of jurisdictions also have debt service funds. And this is where they will typically try to account for the payments associated with, and it's usually typically used for long-term debt like bonds. Some jurisdictions don't use it. For example, we used to have one for a particular debt issuance. And the reason why we had it was because we did a single debt issue for water and sewer improvements. So water paid for its portion, sewer paid for its portion. They're separate funds because they're separate enterprises. And those monies went to a debt service fund to pay for the debt because it was a single obligation, a single note, or a single issue, I should say, not a single note, a single issue. And that was how we did it. But once we closed out that bond, once we finished paying that bond, we ended the use of the debt service fund. But there are a lot of jurisdictions out there that use debt service funds because it allows them to better track how they manage their payment of debt. There are what's also known as capital project funds. In North Carolina, these actually are handled a little differently, but capital project funds are more for particular like one-time capital expenditures. Like if you have, if you're a larger city, like say Charlotte or Raleigh or even Greensboro, you're going to have, typically on an annual basis, you're going to have at least one or two major capital projects, whether it be rehabilitation or building of new public facilities. And so you're probably going to have a fund that manages and handles the expenditures. And you want to track that separately so that you can properly track for it so it's not commingling with other expenses from other accounts. And then the last one it talks about are what they call permanent funds. And this is typically for resources held in trust where the earnings, not the principal, may be used for public purposes. A example they don't have a lot of these, to be honest. They're very few. A common permanent fund long ago was for operation of cemeteries. And what they would do is they were built when cities, of course, municipalities own cemeteries. Most of them do. We own several here in Rocky Mount. And typically, the idea originally was that when you collected the revenues that people paid for the purchase of their cemetery plots, that you would put that money into a permanent fund with the goal that the proceeds of the interest from that fund would help to cover the perpetual maintenance of that cemetery. In long story short, that has not happened. Because the cost of maintenance continue to go up, and eventually you run out of plots to sell. So there are a few places that still have these permanent funds, but for the most part, they are now the maintenance of cemeteries is likely being subsidized by general government revenues. For example, our cemeteries are managed entirely in the general fund. We consider the revenue to be current revenue. Our perpetual care costs a lot more than what we bring in revenue from plot sales. The next kind of fund are the proprietary funds. And these are really reflective of what I would think of as the business type units within an organization, within a jurisdiction of government. The most common one is what's known as the enterprise funds. And these are self-supporting operations, electric utilities, natural gas utilities. There's over 60 municipally owned electric utilities in North Carolina. There's thousands across the country. Water and sewer, pretty much every local jurisdiction or most sizable local jurisdictions have those, even if they don't have electric and gas. But another example is airports. If an airport's owned by a municipal government, it's typically run as an enterprise. Solid waste operations might be run that way. Some are run out of run out of the general fund. Another example that's become more frequent now is for stormwater management. Stormwater management, the manage of storm drainage and making sure that you can prevent flooding as you increase residential, commercial, and industrial development in urban areas. That's a fee-based service, and it's treated as a utility because it's supposed to be a self-sustaining enterprise. And that kind of was started in the early 2000s and continues. We have one here in Rocky Mountain, and most jurisdictions in North Carolina now have one. The second type of proprietary fund that he talks about is the internal service fund. And this is where you have an internal business within government that serves the jurisdiction. So basically what you're doing is you're creating a fund to provide a certain internal service that everybody uses. And so what ends up happening is the departments and the other funds pay a fee for it. That revenue is collected in the internal service fund, and it is used to cover the expenditures. So examples of these have to do with like vehicle and fleet operations, information technology, communications, building maintenance, those kind of internal operations where you would properly assess a fee for that service internally. It would then be expensed by, like, say, the police department or something in the general fund, or by the utilities if you have those in the enterprise funds. And then it would go into this internal service fund as revenue, and they would use that money to cover their expenses of providing the service. And then the last one are the fiduciary funds. And some governments have these. These are where we're accounting for the assets that are held by the government as a trustee for others. And the good example that it gives are pension funds. There are a few municipalities in North Carolina that have their own pension funds. Durham, I believe, is one of them. There are also what they call trust funds. These are insanely controlled. Like, for example, we have what we call the canteen fund, also known as an agency fund, where we collect, where it's basically money that we are the trustee of that we use for very specific purposes. So like, for example, the reason why it's called canteen is that a lot of the accounts in there are tied to the money that departments receive from the commission of their vending machines. And that money can be used for very limited purposes within those departments. One of those being, it can be used to pay for like Christmas parties. But it has to be, it's very restricted in how it's used, and everything is typically balanced on an account level where there's one revenue account and one expenditure account, and those accounts have to remain in balance. So that's the kind of control that we have on it. That's a lot to it. And all of this is audited and evaluated on an annual basis. So you have this system, and then there are some reports that try to bring all this information together to try to provide a full picture of the finances of a given jurisdiction. And then it is separated out by funds so you can kind of see the value of each fund, because you may have circumstances, particularly with enterprise funds, where certain enterprises are doing very well and others are not. And it just depends on economic conditions or other factors that have to be taken into consideration. Something that's very important as well in terms of what we do, and it really is important to understand, is what we call the basis of accounting. The definition as provided on page 83, the method of matching revenues and expenditures over time. There are really three different types, and they're kind of talked about, and the definitions here are very good. We don't have to go into too much detail, but it's important you understand how governments really do it, particularly at the local level, but also at the state. Most of us in our households, and even most small businesses, utilize what's known as the cash method. And when you think about it, it's kind of like balancing your checkbook. And I know for some of you, that is a way old reference out there, but it's very similar to budgeting a checkbook or trying to do it on a single spreadsheet. and the cash method here, it talks about that revenues are posted when the cash is received. So for example, think of it like your statement online with your bank. When you get paid, whether it's every month or every week or every 2 weeks like me, you get that money in your checking account on payday. And that's when you recognize the revenue. So that's when the revenue is posted. It's posted when it's received. And then payment, the expenditure is posted when the payment is completed, or the cash payment. And of course, it doesn't have to be cash, but whether it be a cash or a check or an electronic payment, like on a debit card, it's the same thing. So thinking of it like how you use your bank account is a very easy way of understanding what the cash basis of accounting is. And again, that's what most of us use in personal finance, and a lot of small businesses use that as well. In the private sector with corporations, it is very common to find that they use what's known as full accrual. And in this model, it's a little different. Revenues are posted when they are earned, not necessarily when they're received, but when they have been earned. So a revenue can be earned before it's received. So an example like this is, I'm a business, and I charge for a service, and I issue you a bill. I record and post that revenue when I issue you the bill, not when I've received payment, but when I've actually issued you the bill. And so I have to, that's when I post the revenue. So that's a little different than under a cash basis. And then on the expense side, the expenses are posted when a good or service is used. In other words, we post the expense when the product has been consumed or used, not necessarily when we paid for it. So it may be before we pay for it that we post the expense, or it may even be after we pay for it that we post the expense. But it's actually when the good or service is used. In local government, in general government operations, we typically use what's known as modified accrual. And modified accrual is kind of a hybrid between the cash model and the full accrual model or accrual model. In modified accrual, revenues are posted in the period in which they are measurable and available. So that means that, for example, when we collect tax revenue, we don't post that revenue until we've actually received it. Now, for example, with property tax, we know how much property tax we're expecting because we bill for it. You know, you as a property owner don't estimate what your property tax is. We know it is based on the value of the given property and the rate. So based on the assessed value and the rate, we're able to calculate the taxes, and so we send you a bill for it. But we don't post that revenue until we receive it. And the reason why is because we want to make sure we're only showing the revenue that's available. We expect some revenue not to necessarily be shown. And that's a little bit of a difference. However, in certain cases, we may, in general government, go ahead and post a revenue when we issue a bill. Like if we issue a bill for a service, in some cases, we will post the revenue when we've issued the bill. So like I mentioned before, some cities still provide, in a lot of cities, including Rocky Mount, sanitation services like residential garbage collection and recycling collection are still run in the general fund. But it's run, but we charge on the basis that we expect you to pay. We will cut the service off if you don't, or that's the concept. So when we do that, we go ahead and post the revenue when the bills are issued, and those bills are issued monthly. So that's a little bit of a difference. So there is a little bit of a difference in how revenues can be collected. On the expenditure side, expenditures are posted when the liability is incurred. And this goes back to what I talked to you about with the encumbrance. So if I place an order, like let's, for example, say I need to buy a vehicle. I need to buy a truck. And it could be either a truck or I could be buying a pallet full of copier paper. Either way, I'm going to place an order with a vendor. And once I place that order with a vendor, I've incurred a liability. So unless I cancel the order which is highly unlikely. It does happen occasionally, but it's highly unlikely. But unless I cancel the order, I've incurred that liability. So at that time, I have encumbered the expense. So in those particular cases, that money is no longer available. And for budgeting, this is very important because we want to make sure that we capture expenses as soon as the liability is incurred, so that we can properly show in our journals and we can properly journal the information and show in our ledger how much money is really available. So for example, I might have an account that has $100,000 budget. Now it may show that I've only actually paid out $10,000 of expenditures, but I could have an encumbrance of $50,000 where I'm waiting to actually pay until I receive. You don't pay until you've actually received product. You don't pay in advance typically in government. And so what I need to do is I need to encumber that, say, $50,000, like encumber it to make sure that I don't spend it somewhere else. So you take the 100 minus 10 that's actually been paid out minus 50 for the encumbrance. That leaves you with 40,000. I don't have 90,000 to spend. I only have 40,000 to spend. So that's very important. And as he says here, when it comes to general, and I will say this, when it comes to general, governmental, as well as fiduciary funds, you typically use the modified accrual basis. For enterprise funds, almost all the enterprise funds I'm familiar with are full accrual. Like our utility funds are that way. We treat them on a full accrual basis. So that's how we operate as utility enterprises. That's on an accrual basis, whereas modified accrual is used in general government. So I want to talk about, this is the last part of the reading, and I'm going to show you a couple of examples. There, as I've talked before, we have different ways of monitoring financial performance. And the thing we have to keep in mind when we're monitoring financial performance is that we're doing snapshot analysis. Everything is at a particular moment in time. And there's two tools we have for this. The first one is something that all governments do, and that is what's known now as the Annual Comprehensive Financial Report. It used to be known as the Comprehensive Annual Financial Report. Now it's known as the Annual Comprehensive Financial Report. This book came out several years ago. That this moniker only changed in the last year. So I want to show you an example, and this is the Annual Comprehensive Financial Report for Rocky Mount for the most recent fiscal year that ended June 30th. It's available online. I can send you all attachments if you really want to dig into it. It contains a couple of key parts, and the Government Finance Officers Association, as well as GAAP and as well as the state, have certain expectations and requirements for what these reports contain. Obviously, there's a table of contents. The first thing that you typically find is a letter of transmittal. The first section is what's known as the introductory section, which includes the transmittal letter, which is prepared by the jurisdiction that's being reported. It's just some general information about the city. You would have an org chart in it as well, and then also some information about principal officials. The second part is known as the financial section, and this is really some very important information that we try to gather. The first thing is the independent auditor's report. Now what annual financial reports do is it not only is including performance information, it also includes the results of the audit. And what you're trying to do in an audit is you're trying to make sure that your actual practices are consistent with the policies and procedures and the guidelines and the controls that you have in place for appropriate financial management. So the independent auditor's report, which is a letter, basically indicates, are you doing what you're supposed to do, or did they find any problems? And the shorter the auditor's letter, the better off you are. Typically, when I was in class 20 years ago, the goal was to have a one-page letter. There are some changes in practices and standards where they have to add a little more information, but typically you don't want it to be any longer than it's supposed to be. Subsequently, after that, you have what's known as management's discussion and analysis, where those that are involved in the financial management of the jurisdictions and provide some additional information. They may talk more about debt. They may talk more about other things. You have what's known as the basic financial statements. You have, and I can go into further detail at another time, additional financial data and other schedules. A lot of information is included in here. So, like, for example, let me just show you, going through here, like this is what's known as a statement of net position. And really it's to kind of, and again, this is a snapshot. So this is at the end of the fiscal year. So what this does is it really kind of gives you an idea of what you have in terms of assets and liabilities. And this is getting more into the accounting side and the financial condition in terms of the overall position. And for example, in our government, we have governmental activities and business type activities. So the business type activities would be our enterprise funds. And overall, we have assets that total, you have in governmental, you have about 216.5 million. And in the enterprise business type activities, you almost have 260 for a total of 476.4 million. Then you have your liabilities, and there are different types of liabilities. Liabilities are actually pretty small, so this creates a very strong net position for us as an organization, and that's where you want to see. And of course, there's different ways that net position is presented, but all this is very important. You then have your statement of activities, which actually indicates the activities that took place in the most recent fiscal year, from a standpoint of expenditures as well as revenues. And then this information, this is more combined together, and then this information kind of gets broken out into more detail on a fund basis and below a fund basis over the course of the document. Following that, you have also what's known as the statistical section, which I'm looking for. Most of this book is tied up in what's known as the financial section, and then there's another section which is what's known as the statistical section. Yeah, here we go. The statistical section, and this is a lot of data, and typically you're providing 5 to 10 years of background data to really kind of help give you an understanding of the overall financial performance. So this is very good information as well. Like for here is an example of revenues by source, and you can see it's from fiscal year 2012 to fiscal year 21. So it kind of enables you to see a comparison of various revenues that are part of the general governmental funds. So this would be all of them. Like I talked about ad valorem taxes, which come from real property or from vehicle property taxes, the telecommunications tax, other types of intergovernmental revenue, and so on. And it kind of gives you an idea overall of how revenues have performed each year. So this is important information. There's a lot of great information in this. What I'll probably do is make this document available. And you can look at the one for Greensboro. You can look at the one for any town or county that you're interested in. Pretty much everybody has it on their website. What this information is also used for is it's also used to do financial condition analysis. And there's some examples of that Mike Sell gives at the bottom of page 86 about different types of solvency, cash solvency, budget solvency, long run, and service level, and gives you those different examples. And this is important. And typically when you evaluate solvency or these ratios, and most of these are ratios, you're looking at them year to year. You want to look at how your trend looks. You do want to look at how you compare to other jurisdictions. But these ratios are important because there are some, in some cases, and this book doesn't go a lot into it. I can go into it in more detail if you'd like later. But there's a lot you can do to really understand where you are in terms of the solvency of the financial or fiscal condition. The state of North Carolina has its own dashboard. It actually collects this information. There's a report that's the data from the financial reports is used by every jurisdiction in North Carolina and all across the country to prepare what's known as an AFIR report. and that is submitted to the states to kind of give them an idea of how they're doing financially. And of course, this is all governed by the local government commission here in North Carolina, which is part of the governor's, part of the state treasurer's office. And I'll talk about that more next week when we talk about budgeting in North Carolina. And they actually have a tool online that you can use that gives you an idea of looking at financial conditions. So let's say I wanted to look at Greensboro. So I click on municipality, and all I'm going to do is just look at the general fund for Greensboro. So I'm going to go to Greensboro. And I just want to look at the general fund. I'm not gonna pick any benchmark peers for this. I just want to look at, well, I'll tell you what, I'm going to pick one. I'm going to pick Winston-Salem. The Pier 1 unit. Okay, it's not wanting to cooperate. Here we go. So I'm going to pick Winston-Salem as the benchmark. Give me just a second. So click on next. And I'm going to do this as a PDF so everybody can see it. Okay, you can see that the PDF has been downloaded, so I'm going to pull this up. And what you'll see here, and I'm going to just use these resource flows. But for example, one is the obligation ratio, and you'll see here, the blue lines are for Greensboro over a 5-year period from fiscal year 2016 to 2020. And basically, this is an indication of whether or not their revenues were sufficient to pay for annual obligations. And what you can see is typically you want to make sure it's close to or above 1. And as you can see here, Greensboro's is at a 1. The benchmark, which would be Winston-Salem, is at a 0.98. Then you have another one that they bring up called the dependency ratio, which deals with intergovernmental. And that's, of course, how much we rely on the governments for other revenues, for total resources in general government. And as you can see, Greensboro has their dependencies actually dropped a little bit, which is a good sign. There's going to be some dependency, but still it's important. As you can see, Greensboro and Winston-Salem are consistent at 11%. Debt service ratio, as you can see here, Greensboro's has actually kind of gone up a little bit and gone back down. Where they are at around 0.0 at 9% is not bad. That's how much is debt service over as a percentage of total expenditures. 9% is not bad. Winston-Salem's is very low. It's at 1%. That's incredibly low for most jurisdictions. The quick ratio is something you pull from financial statements, and it's the ability to meet short-term obligations. As you can see, Greensboro's is close to 8. That's actually pretty good. Winston-Salem's is pretty strong at 12, and there's a whole bunch of ratios that are in here. And I'll share the link to this at some point because it's really interesting analysis that you can look. If you want to get more into financial analysis, it's a great tool, and it's been around for a while, and it provides some really good information. So to wrap up, we'll talk about our assignments for next week, February 21st. Again, this will be a live session on Zoom. We'll be talking about state and local budgeting. We'll be also looking a little bit at budgeting in North Carolina, so you'll need to read Chapter 5 out of my Excel. The lab video for this week is already up, and it's a continuation of preparation of the budget worksheet. and I've emailed the assignment, and that's due back to me by midnight next Monday. Hope everybody, if anybody has any questions regarding the lab exercises, just remind you to please email me or text me, and I'll be happy to talk with you. So thank you all very much for watching this video, and I look forward to seeing you all again live on February 21st. Take care.